Rezolve AI is currently trading at exactly $2.90 per share, showing a slight intraday contraction of roughly 1.2% as the market digests the massive volume we have seen over the last 48 hours. If you are watching the charts right now, you will see it bouncing between a daily low of $2.60 and a high of $2.95. That kind of spread, nearly 35 cents on a sub-$3 stock, tells you everything you need to know about the battle happening right now between short-term traders taking profits and long-term believers accumulating shares. Most retail investors looking at this chart on their mobile dashboards might just see a volatile small-cap tech stock trying to find a bottom, but that surface-level view completely misses the tectonic shift that just occurred in the company's fundamental structure. The expectation here, especially if you look at the chatter on social media or the basic headlines, is that Rezolve AI is just another cash-burning speculative play, hoping to catch a tailwind from the broader sector hype. The reality, however, is significantly more complex and aggressive. This is no longer just a software company trying to sell a product. With the recent news of the Crownpeak acquisition, Rezolve has effectively morphed into a holding company that is buying its way into massive revenue streams. They aren't waiting for organic growth to justify their valuation, they are acquiring it. When you realize that they just picked up a company generating $70 million in revenue, while their own stock trades at these levels, the math starts to look very different than what the bears are projecting. This disconnect between the penny stock perception and the enterprise acquisition reality is where the real story lies today. To understand why this stock is seeing such violent swings, we have to look at the immediate catalyst. The market is currently trying to price in the acquisition of Crownpeak, a digital experience platform. This is not a small tuck-in deal. This is a transformative move valued at roughly $240 million when you factor in the debt assumption. For a company the size of Rezolve, taking on that kind of leverage and operational weight is a massive gamble, but it is also the kind of move that separates distinct market players from the noise. You might look at Tesla stock or Apple stock and see companies that grow by iterating on products they already dominate. But in the small-cap world, growth often has to be manufactured through aggressive consolidation. Rezolve is betting that by integrating Crownpeak's 400 enterprise customers, big names like Sephora and Calvin Klein, they can cross-sell their proprietary BrainSuite AI tools. The market's hesitation today, reflected in that 1% drop, is likely due to the complexity of the deal. Investors are asking, can they integrate this? Can they handle the $150 million in assumed debt? It is a classic show-me moment. If you are managing your own funds in an individual brokerage account, perhaps via Fidelity Investments or using the Robinhood app, you are likely seeing this volatility trigger alerts. It scares off the passive money, the kind of capital that sits in Schwab Intelligent Portfolios or boring index funds. But it attracts the active capital that understands the mechanics of a roll-up strategy. The volume we are seeing, over 18 million shares traded recently, suggests that institutional hands are swapping paper with retail traders who might be panicking a bit too early. The core of the bullish thesis here relies on a concept called Agentic Commerce. This is a term you're going to hear a lot more, and it differentiates Rezolve from the generic chatbot companies that flooded the market last year. Most AI we interact with is passive. You ask it a question, and it gives an answer. Rezolve's technology, backed by partnerships with Microsoft and Google, is designed to be active. It doesn't just answer, it executes. It can handle the entire transaction layer, moving a customer from "I want this" to "order confirmed" without a human ever touching the process. When you consider the friction that currently exists in online retail, removing those steps is worth billions. If you trade NVIDIA stock, you know that the hardware layer is the first phase of this AI build-out. The second phase, which we are entering now, is the application layer, the software that actually does work. Rezolve is positioning itself as the infrastructure for that layer. By acquiring Crownpeak, they aren't just buying revenue, they are buying the rails to run their AI trains on. They instantly gain access to a massive installed base of customers who are already paying for digital experience software. It is much easier to upsell an existing client on a new AI module than it is to go out and find a brand new customer from scratch. This is the land and expand strategy on steroids. However, we need to have a serious conversation about the risks because ignoring them would be irresponsible. The debt load they are taking on is real. In an environment where interest rates are a constant concern, servicing $150 million in debt requires serious cash flow. This is why the stock didn't immediately moonshot to $5 on the news. The market is calculating the cost of that capital. If you are using interactive brokers trading platforms that allow you to see deep into the order book, you probably saw a wall of sell orders at the $3 mark. That is likely arbitrage funds or older holders using the news liquidity to exit. It creates a ceiling that the stock has to chew through. Furthermore, the operational risk of merging two different corporate cultures, Rezolve and Crownpeak, is high. Tech history is littered with failed mergers where the synergies looked great on a spreadsheet but fell apart in the office. If Rezolve takes their eye off the ball, that debt becomes an anchor rather than a lever. This is why you don't typically see these kinds of plays recommended in conservative Fidelity wealth management brochures or standard Fidelity ETFs. This is a high beta, high risk, potential high reward situation, suitable only for those who actively manage their self-investing strategies. Let's talk about the specific numbers that came out with the guidance update, because this is where the reality part of our thesis really kicks in. Rezolve raised its guidance for the 2025 exit rate to $150 million in annual recurring revenue. That is a specific, hard number that they are now on the hook for. In the software world, companies are often valued at a multiple of their ARR. If they hit that $150 million target and you apply a reasonable multiple, say 5 to 8 times sales, which is common for growing AI SaaS companies, you can do the math on where the market cap should be. Currently hovering under a $1 billion market cap, the stock is trading at a discount to that future potential, assuming they execute. But the market hates assumptions. It wants proof. That is why the price is pinned here at $2.90. It's a waiting room. The moment they release a quarterly report showing that the Crownpeak integration is working and that the ARR is actually tracking toward that target, you could see a violent repricing. This is similar to what we saw in the early days of SoFi stocks, or even during the initial volatility of Robinhood stock trading post-IPO, where the market struggled to value the company until the earnings prints stabilized the narrative. I want to pause here and get your take on this aggressive acquisition strategy. It's a bold move, but is it too much too fast? Comment below how many shares of Rezolve AI you currently hold or if you are waiting for a dip to enter. And also let me know, do you prefer companies that grow slowly and organically, or do you like these aggressive roll-up plays that buy revenue? Your comments help the algorithm, but they also help us gauge the sentiment of the real traders out there, not just the Wall Street analysts. Now, shifting back to the market mechanics, we have to discuss the float. Rezolve has a relatively manageable float, which means that any significant influx of volume can move the price fast. We saw this recently when the stock jumped over 12%. Low-float stocks are a favorite of day traders on Robinhood investments platforms because they offer that intraday volatility. But for the long-term holder, this can be nauseating. You have to be prepared for days where the stock drops 5 or 6% on no news, simply because a large block seller decided to liquidate. This is where using limit orders instead of market orders is crucial. If you are placing trades through SoFi Invest or your Interactive Brokers account, never just hit buy market on a stock like this. The spread can widen and you will get filled at a bad price. Always use limits to control your entry. The partnership angle is another pillar supporting the bull case. They aren't just working in a vacuum. Their relationship with Microsoft is strategic. Microsoft is currently in an arms race with Google and Amazon to own the enterprise AI space. By partnering with agile application layer companies like Rezolve, Microsoft ensures